But what it is, Karen, is ultimately investment's about one thing. It's about expected returns associated with the cash flows that the company you're investing in generates. That's why all the analysts out there use discounted cash flow analysis. The difficulty we now face is that cash flows, there's lots of ways of measuring cash flows. Earnings, for example, is a way of measuring cash flows, future cash flows. But whereas historically we tended to sort of focus on the short-term news as really more about the trading side of things, what's really important now is that those long-term growth forecasts that analysts would have in their models, they're now needing to be informed much, much more by what we're seeing coming through the news reports on channels like CNBC and on the wires every day. It's not just about did that hit or miss happen against expectations. It's how is that really going to be changing my view of long-term growth? Because everybody's business model's now being questioned. And for the first time, people are really going to have to start looking at that data that you're getting day to day, coming through in the earnings reports and say, does this really shape my view of the longer term now? Because I used to just look through that stuff as noise, but as an investor, not traders, but as investors, people are really now looking at these data points much more closely, and their forecasts for longer term cash flow, i.e. the value of the business, is going to become much more driven by this information set coming into them. It's a change in the way I think investors are going to be looking at data as we go through the next 12 to 18 months. And I think not only is that a good thing, but it's also going to reinforce the fact that the investment decision in the business is not just about a very short-term trade, and it's not about thinking about a very, very long-term growth story. It's realizing that companies like economies are now going to be reorientating towards expectations of growth that are driven by a very, very different macro background. I mean, we're heading to negative interest rates around the world. That makes understanding what the corporate outlook is for cash flows really quite different now.
Almost impossible in some industries, though, Chris, it would seem. I mean, we already had Ryanair's CEO on just a moment ago saying that the cost of capital for his industry has become almost irrelevant when you've got governments that are willing to step in, as they have done with Alitalia and Air France and others, and effectively put a backstop on businesses that were previously struggling and gave Ryanair a tremendous competitive advantage. So how easy is it going to be going forward for many industries to figure out who the winners will be if the cost of capital is almost a nonsensical number in any calculation?
Well, this is absolutely the heart of it, Jeff. And the point about the cost of capital is that the markets have steadily seen bond interest rates driven down both at the government level and also the investment grade level down towards zero in the last few years. Now we've seen the rest of the credit curve going down to those kind of levels. And as we saw recently, the fact that LVMH can raise debt below zero and then go and buy equity assets with it, I mean, that's a complete change in the way you think you're going to price a stock. If you're going to go and buy assets with cash where you're basically being given debt below zero, then that's what's setting the value of the asset now. It's not the analyst model based on a implied cost of capital or a return on capital expectation. If your cost of capital is basically zero, your return on capital can also be very, very low. And that's actually a very positive thing for equity prices, because obviously if your return on capital expectations are low because you can fund at a lower rate, it's not the fund manager who's setting the price in the market. It's possibly the acquirer. It's possibly the Tiffany share price being set by LVMH is not being set by a market analyst anymore. It's being set by the fact that they can raise money at zero. So in that sense, they can pay a much higher price for that asset. This is what's changing. And actually what we need to know is if I'm going to be working with effectively a cost of capital of zero, my real concern now is where is my valuation? And my valuation has to be, I need to really understand the company's future cash flows, and I really have to understand what value I can place on them. So that's why the data flows are much more important now. That's why understanding what that outlook is for Ryanair, you don't know what it is, but every data point, every comment you get, you've got to have a forecast. If you're an analyst, you have to have a view. If you're an investor, you have to have a view on what you think a stock is worth. What you do know is if it's a viable business, it could be worth a lot more than your old models were telling you. And if the market keeps going up and you keep thinking, oh, I better sell because it looks expensive on my old model, then it keeps going up again. We've been there before. That's what happened in 2009, 2010. Everybody said it's too expensive, then gave in. So this is the world we're going into, valuing things in a very different way.